Hey, look, thanks. Thanks for making some time to hear us today. I thought I'd start off with a quick little introduction, and I'll let Emma explain what we do at the Global Value Fund and at Staude Capital. And then after that, I prepared some slides that I thought would be interesting to share to talk about, which is what I believe is going to be the most important topic for finance and for investing for the next couple of years, and that is inflation and interest rates. But I'll get onto that a little bit later. But just to start off, so I'm Miles Staude. I'm the portfolio manager for the Global Value Fund here in Australia. With me is the lovely Emma Davidson. She is the head of corporate affairs for GVF, Global Value Fund, and also runs the management company in London. She's also a terrifically lucky lady because she's lucky enough to be my wife. So it's a 2-for-1 deal with the Global Value Fund. And I guess to sort of talk about us a little bit. So first thing to say is we're a London-based firm. So I grew up in Australia, but I've lived in London for the last 20 odd years. And we've got a big team in there investing around the world. And the second thing to say is we're a bit different. So when we're not stock pickers, I imagine a lot of the guys that get up here and talk to you, and I heard you all having really interesting conversations earlier, was about picking interesting companies, undervalued companies or growth companies. We come at markets in a slightly different way. Instead of trying to outperform markets by picking stocks or bonds, what we try and do is find ways to effectively invest into the market at a discount. So what we do from London is hunt out asset plays all around the world, trying to buy assets that are trading below book value, or for lack of a better phrase, below breakup value. We invest into these situations, and then how we outperform is we've got a big toolkit of how to unlock the value in the things that we invest into. So it's an important philosophical difference, I think. We're not stock pickers, we think of ourselves more as asset traders. In doing what we do, rather uniquely, what we try and deliver is two sources of investment return. You get the return from the assets that we bought really cheaply. Hopefully that goes up through time. But then you get this second source of return, which is by far the most important part of the return for us, and that's us actively unlocking the value from these situations. And if that works together, those two sources of return compound, which is quite nice, and it generates what we think is quite an interesting proposition. Finding discounted asset plays, finding things trading for below breakup value around the world is actually quite easy. There's lots of these things out there. The special sauce, what we do as a team, is really an ability to unlock the value in them. And just really quickly, there's two ways we go about doing that. The first way is a really interesting trading business that we run. We've run for about 15 years now. And in the sorts of things we specialise in, there's these wonderful little arbitrages that we find in the market where you can literally buy $1 for 90 cents and you can arbitrage out in a few months' time. It's been a wonderful place to put capital to work. It's a key part of our intellectual property, so we're a bit secretive about it. And it also, it's not very scalable, so we can never put lots of money into these little opportunities we find. But that's fine for us, and it's one of the reasons we've always said we're going to stay relatively small. The second side of the business is the side that generally gets people's attention the most and certainly gets the most sort of glamour, and that's shareholder activism. So finding situations where you're buying things well below book value, well below breakup value. Typically something's gone wrong then. There's a failure in corporate strategy or a failure in corporate governance. We'll come in, pretty thick skin, engage with boards, managers, other stakeholders, and try, like in a productive way, to try and solve the problem at hand. We've been doing this for a long time now, and we've got a pretty good track record and a very high strike rate of coming into these situations and unlocking value for everyone, and generally being able to do that behind the scenes in a sort of productive way. That's not always the case, and we certainly have our fair share of the gory stories where we have to go into situations and remove directors and be a bit nastier. But that's always the last thing we do. We don't never set out to do that. And when we're being a bit more aggressive, that's generally when there's vested interests at work. When we find boards or management teams working for themselves and not for investors, we can get quite religious about it all. And then I guess the last thing to say, for the Global Value Fund, that's a LIC listed here in Australia, what we set out to do with it, the aim is really to generate equity-like returns over time. So, high double-digit kind of return numbers, high single-digit, low double-digit return numbers, but on a much lower risk profile than you get from investing into the share market. And I'll let Emma talk about the numbers a little bit before I come back.
Okay.
Sorry.
Thanks, Miles, and thank you, everyone. Thank you for inviting us back. I have to say that Toowoomba and Broadbeach are my two favourite locations that we go to, and I keep selling Queensland as the destination that we should settle in, but I married a New South Wales boy, so it's a bit awkward.
You're going to fight the grandparents.
Exactly. Okay, so I'll just speak a little bit of, I'm not going to spend long, but I'll spend a little bit of time just talking about the Global Value Fund on the ASX GVF. We had a really good FY 2021, and we've started FY 2022 off well. For the 8 months to the end of February, we're up 7.5%, and that's versus the MSCI All Country World Index, which is up 1%. Now, our annualized returns from our IPO in 2014 through to the end of February have run at 11.1% per annum, and that's after all fees and costs. Now, a lot of you may know about GVF, but for those that are new, I thought I might just slightly recap what it is that we do and how we work. Miles did go into some of the detail, but I just wanted to show some graphical explanations of that. Miles mentioned we have this differentiated strategy. You know, our core skill set is an ability to go around the world and find discounted assets, and then unlock those discounts, whether it's through corporate actions that exist within the legal documentation, or indeed, a much more obvious example, shareholder activism. Our stated aim, as Miles said, is to target global equity market-like returns, but to do so with a much lower risk profile. And essentially, we're aiming to be that steady Eddie in a client portfolio. What I'm going to do is I'm going to talk about the two sources of returns that we generate for our investors. The first is the assets that we purchase around the world. I'm going to show you two pie charts on the screen. What we do is we go find discounted assets all over the world, and we make sure that we diversify, and we don't just buy assets in equities, but we buy assets across all the bases. So we'll always have, you know, a bit of listed equity here. Then we'll have some listed debt, maybe some private equity, hedge funds, real estate, and Miles will talk a little bit later. We actually own some aircraft at the moment, but that's another story. By going around the world and purchasing these assets at a discount, we also end up holding a basket of currencies. And our whole philosophy with currencies is to largely reflect the global investable universe. So we're not taking any views on currency, we're just trying to diversify the risk profile. So we'll have a large US dollar exposure. Obviously, the US dollar is a huge part of the global investable universe, talking specifically about developed market currencies. We'll then have some euros. We have a large Australian dollar exposure, and then we'll have other developed market currencies like sterling. The reason we have the high Aussie dollar exposure is for an Australian dollar-denominated company like GVF, the lowest risk currency for us to hold is the Australian dollar. So if we pick up any assets in a currency that we're not so comfortable with, such as rubles, or indeed the China, not that we own actually much Russian stuff at the moment, but if we picked up, say, Chinese equity, we would hedge the currency back into the Australian dollar. So when you look at those two pie charts, what you end up with is a very diversified, unique, but conservative portfolio. I want to drive home that point in this following attribution chart. So what I've done here is, in a graph, I've put from our IPO in 2014 through to basically end of last year, I've attributed out what those two pie charts have achieved. So that is what the assets that we've purchased around the world have done for us. Not too much. That is what the currencies that we've held through time have done. And as you would expect, a largely diversified pool of assets creates a low-risk basket of assets, and that returns a low return. And that, over our lifetime since 2014, has produced about 6% per annum. The way that we outperform and the way that we achieve that 11.1% net of all fees is we strap on top all of the discounts that we purchase those assets at. And that is how we top up the returns to that much higher level. This top navy line shows GVF's net after all fees and costs, net returns, and hopefully illustrates that real market outperformance that we've delivered through time. As I mentioned, GVF, since our launch in 2014 through to the end of February this year, we have managed to achieve 11.1% per annum for our shareholders. And we've done that with an average of 30 to 40% exposure to global equity markets. So a much lower risk profile, but we've still managed to keep up with those global equity returns. Now, probably the most important part of what we do is we aim to pay out all of our investment returns back to shareholders as franked dividends. Now, this slide illustrates all the dividends and franking that we've paid out since our IPO, and hopefully illustrates to you that consistency and reliability of the 8 to 9 cent grossed up dividend stream that we've paid out now for 5 years. So on the initial $1 that was invested at IPO, GVF has actually paid back 56 cents on that $1. And in addition, we have a profits reserve of 26 cents per share, which means that no matter what happens over the next 4 years, we have the ability to pay dividends from our quarantined profit reserve. One more graph, if you'll indulge me, before we get onto the interesting stuff with Miles. And this is my favorite graph. This is a graph that shows every single trade that GVF has ever done during its lifetime, from IPO through to February. And it shows the profit on the left-hand side or losses on the right-hand side of every single one of those trades. What I love about this graph is it has, we're all expecting a huge tail on the right-hand side, but it's actually not the case. And I think that's the thing that I love most. It's really easy to go to the pub and talk about the returns that your portfolio has generated. What's not easy to do is to quantify the risk that you took in order to generate those returns. I'm hoping that what this graph does is illustrate to you the risk that we took in order to generate the 11.1% per annum that we've achieved since our IPO.
It's tough doing these presentations. Like I sat down in London and thought about speaking to groups like this, and thought I'd put together some really interesting slides on what's important in the world and what's going to drive financial markets. The team and I put a lot of work into that, and this is the culmination of the slides you're going to see now. As the way the world goes, we did all that work and hopped on a plane, and then a lunatic has decided to start a war, and then that's obviously what's driving markets right this moment. I think the things that I'm going to talk to you about today are really the underlying drivers that we have to think about for the next few years, and are what is going to reassert themselves as the most important things for investing over the next 18 to 24 months. Obviously, in the near term, what this tragedy that's going on in Ukraine is going to dominate the headlines, but I would suspect that in a few months' time, markets are back to worrying about this sort of stuff. Rightly or wrongly, financial markets are there to price assets. They're not there to make a moral judgment on things. And as a general comment, it doesn't feel emotionally right, but financial markets have a terrible tendency of overreacting. If you look at when Saddam Hussein invaded Kuwait, financial markets were back to all-time highs within a few months. Russia is not a very big part of the global economy, and the transmission mechanism of what's going on is really its impact on the commodity markets. But anyway, I'll talk a little bit about the war in Ukraine if people are interested, but mainly I'm going to talk about what I think is the most important thing going on in the markets today. And I'll just get my notes. Inflation. It's something we haven't had to worry about for a very long time. I think last time I was here, I was probably talking about why inflation was so low. It was a problem, it was something we had to worry about. And in a very short period of time, it's come back onto the radar for everyone. Just to frame the situation, so in the space of just a year, so this time last year, inflation in the US, the biggest economy in the world, running at 1.5%, pretty anodyne. Today, it's running at 8%, a figure no one would have believed you if you told them a year ago. Same in Europe. A year ago, inflation was running at negative inflation rate, something that's really concerning. Today, it's hitting 6%, similar sorts of moves in the UK. Here in Australia, we've had a big pop. It's not quite as extreme as those numbers I've said, but we've gone from less than 1% to more than 3.5% in the space of 12 months. Quite a big move. And I guess the first thing to say is, why do we care? What's the problem with inflation? Well, any of you with some savings in the bank probably care quite a lot. Inflation decreases the value of money. So it decreases the value of our wages or our cash savings, and it increases the value of physical assets like cars, machines, houses, that sort of stuff. Most importantly, at least in my view, inflation, I think, is as much as anything a psychological phenomenon as it is an economic phenomenon. Periods of high inflation have this horrible tendency to become self-reinforcing. When you see the value of your savings or your salary falling, you naturally want to charge more for what you sell or what you work for. And the more of us that do that, the more it becomes self-perpetuating, and what happens is high inflation today starts to mean high inflation tomorrow. And the reverse of that happens. Like if we have long periods of low inflation, which we've had for a long time now, people drop it out of their expectations, and low inflation today starts to mean low inflation tomorrow. So there's sort of this really important psychological cycle that goes on behind the scenes. I'm an economist by trade, so I always start with sort of the economic theory, but the last thing to say about inflation is that economic theory says that a little bit of inflation is good for a system. So that's why central banks target inflation of a couple of % a year in most grown-up countries. Here the target is 2 to 3%. In the US, in the Eurozone, it's 2% a year. So we always want a little bit of inflation, but recently it's kind of gone a bit crazy. You can see here on this chart inflation in the US, the Eurozone and Australia, just sort of three big economies, and obviously Australia is a reference point, up until the start of the pandemic. And what's really interesting, like the big debate, I would have been talking about this I think in 2019, the big debate in economics for the last decade has been this concept of secular stagnation. The problem policymakers faced was that inflation was consistently too low. They were worried that inflation was consistently too low. They needed to get it higher. That was sort of the backdrop for this concept of secular stagnation. You've probably seen the concept bandied about in the press or people like me talking about it. The drivers behind secular stagnation, if we're honest, we don't really know what was going on. A lot of them are to do with big technological changes that we came along, disrupted entire industries, and demographics. Rich world society is getting older, putting pressure on these sorts of things. But it did mean for a long time inflation was dangerously low. And you can see, there we go, the average inflation levels in those three big economies were well below target. In the case of the Eurozone, average inflation for the decade before the pandemic was 1%, so half of what the Eurozone was mandated to try and achieve. While secular stagnation sounds pretty grim, and it's not particularly nice that growth is too low and all the implications from that, it had this wonderful silver lining for investors and for most of us in the room, and that is it let central banks constantly cut interest rates lower. So central banks, their job is to manage inflation. Inflation is not a problem. They can keep cutting interest rates lower and lower and lower and try and boost economic growth. Which is, great, keeps their job nice and easy. But the challenge we've all faced, or what we would have all seen in the markets, is that interest rates and asset prices move in the opposite direction. It's a bit like a child's seesaw. You push down on one end, the other go up. And we've all seen that pretty spectacularly in recent years. In the property markets and the share markets, the returns most people have enjoyed in these asset classes in the last 5 to 10 years are well above long-term averages. And to be honest, or to be fair, well above what you should probably expect if you've got a sort of fair-minded view on these sorts of things. And that's the important point to understand with what's going on at the moment. We've all kind of enjoyed this wonderful free kick in the last few years. We've all kind of made money a little bit too easily. And with the return of inflation, that's what's got everyone so worried. You can see now, if we fast forward through the next 12 months, what has happened with inflation in these three economies. And we did these charts in January. What you can't see is that US inflation has kept going up higher still. It's just touched 8% last week. An 8% print for US inflation is terrifying. That's the highest reading in 40 years. If it was sustained, it would be devastating to the global economy because so much of what happens in the US drives what goes on in the rest of the world. Fortunately, it's very likely, famous last words, but very likely that inflation is going to start falling this year and next. And that's really the key debate that's been going on in the market for a little while now. How fast is inflation going to fall and how far is it going to fall? Because that's going to have a really big impact on what interest rates do. We do have some insights into this. The market prices everything. So you can see on these dotted lines here, the forward price of inflation. So what the market currently thinks inflation is going to do. And we can see that. It's quite interesting, actually. You can see what the market is pricing inflation to be. by the different prices of bonds. If you buy a regular government bond or an inflation-backed government bond, the difference between those two securities is essentially the market price for inflation. And there's two things that I hopefully can stand out quite striking. Is one, that the market does think inflation is going to fall back, so hopefully this is not a disaster. But secondly, that it's going to settle at a much higher level than we had in the decade before the pandemic. Those two dynamics, how fast inflation is going to fall and where it settles, in my view at least, is going to drive what asset prices do for the next little while. Much more important than economic growth, much more important than which side of politics is in power in the next little while, because of its transmission mechanism on interest rates. And I'll give these two next little slides so we give a little example of why it's so important. So inflation has been building and building for about 12 to 18 months now, and most of last year the market was very relaxed with what was happening with inflation. There was this concept out there that inflation would be transitory, and again another term you probably heard bandied about in the press. The US Federal Reserve was adamant in saying, yes, we're seeing some inflation tick along, but it's nothing to worry about, it's going to be a transitory phenomenon. And if we fast forward, this is US interest rates up until June of last year, so the middle of last year. In June of last year, inflation in the US, biggest market in the world, was running at 5%, so 2.5 times what the Federal Reserve has mandated to keep it at. However, everyone in the market thought this is a very short-term thing, it's nothing to worry about. And again, you can see here what the market thought interest rates. Would you mind doing the forward curve?
Sure.
What the market's future thinking on interest rates would be. So you can see in June of last year, markets thought interest rates, inflation is very high, but interest rates are going to stay low for a very long time. This is nothing to worry about. Instead of that, what's happened is you've had this dramatic spike in short-term interest rates and this shift in market expectations, where the market now thinks that interest rates are going to rise much more quickly in the near term. This might seem like sort of anodyne, granular stuff, but it has real-world implications in financial markets. We've gone from thinking there wouldn't be any interest rate rises in the US this year to the market now pricing in 7. And that's a huge shift in big asset classes like equity markets and bond markets. And it's really the driver of what happened. If you remember, before Ukraine, we had a real hiccup in the markets. Markets really sold off in January of this year. And this shift in interest rate expectations is what was behind all of it. Now, why did interest rates shoot up like that? Why is the market suddenly thinking that interest rates are going to rise a lot quicker? Well, if we jump to the next chart, this shows US inflation until June of last year. I was saying 5% inflation, the Fed's out there saying this is nothing to worry about, it's transitory. And then you can see what the market thought inflation was going to do then. The market thought this is a very short-term spike, it's going to come back down very quickly. Unfortunately, inflation kept going up, quite dramatically so. And you'll now see expectations are that it falls slower and settles higher. And that's really the dynamic that's worrying everyone at the moment. And unfortunately, what's happening in Ukraine makes this dynamic much more acute. I don't think the market's really found its feet on this point yet, but going forward, the problem we face is, a central bank has two jobs: keep economic growth high and inflation low. And if economic growth is getting too low, you cut interest rates. If inflation is getting too high, you lift up interest rates. They're suddenly presented with, the backdrop that I just told you about on steroids. The war in Ukraine, the Russian invasion has sent commodity markets into the stratosphere. All of these inflation numbers I'm talking to you about now are pre the war in Ukraine. So the 8% print in the US does not include the impact we're going to see coming in petrol prices and food prices and all that kind of stuff. So we've got a guaranteed another leg up in inflation coming. At the same time, it's done a lot of damage to global growth. So we should expect growth to start slowing, particularly in Europe. The numbers I'm seeing in Europe now are looking pretty bleak. So if you're a central bank, you've got to keep economic growth up. So I guess, I should cut interest rates, but gosh, inflation's going even higher, so I'll lift interest rates. It's going to make that handoff, that job that they've got to do, very, very tricky. Now, I wish I could stand up here and tell you what's going to happen with inflation and interest rates. We'd all make a lot of money. Unfortunately, forecasting these things is a bit like forecasting the Australian weather. Even the smartest economists can only give you a very vague steer on what's going to happen. So more helpfully, we think, and it's certainly the way that we're positioning the portfolio and thinking about lives ourselves, is really just to prepare yourselves for two very likely outcomes and make sure your portfolio or your investments can weather both of those. The first is the optimistic scenario. So, whilst these numbers look very scary, and I get a lot of the commentators are sort of making comparisons to the 1970s and things like that, there are some really good fundamental reasons to think inflation is going to come back down again reasonably quickly over the year ahead. The pandemic and the way we dealt with the pandemic was really peculiar. We basically turned the global economy off, shoved a lot of money into everyone's pockets, then turned the global economy back on. So we've come out of what should be a recession all loaded up with cash, with interest rates super low, supply chains all in haywire because we've hit the stop-start switch. All of that stuff should start washing its way through the system throughout this year, and that's why the market is pricing that will do that. And so long as that's the way it pans out, so as long as inflation does start to fall down again reasonably quickly, yes, interest rates will go up, but in the context of things, if you can remember that slide before, some of you with longer memories, if interest rates settle at sort of 2%, there's hardly going to be a crisis for a market that is still incredibly cheap based on long-term history. So under the more optimistic scenario, I guess the way to think about life would be there's going to be a big headwind we have to work our way through. Inflation, interest rates, they're never good for asset price returns, stock markets. But we're probably not in store for negative returns, just it's going to be a lot less fun. The last few years it's been, share markets have kind of been on a wild ride. Looking ahead, maybe it's just more subdued. Investing is going to be less fun, but certainly not going to be a negative sort of environment. The second scenario is the scarier one, and this is the one that hopefully is not the most likely outcome, but the longer the war goes on, the more likely it becomes, I think. And that is, what happens if these high inflation numbers we're seeing don't start falling down, if they start to get baked into expectations. And as I was saying before, the mechanism for that to happen, the thing to watch really or to worry about, is through wage expectations. It's all well and good telling the man on the street that, this inflation you're seeing is transitory and you don't need to worry about it. That doesn't change the fact he's taking a real 8% pay cut. And that real 8% pay cut is coming at a time of really low unemployment. It's also coming at a time when a big change in working practices after the pandemic. We're all out there finding our bliss now. A lot of people starting their own businesses or retiring early. There's a real shortage for workers out there. It's hard to force on that kind of cohort an 8% pay cut. The other thing too, just to say, it's the argument that this is transitory is wearing thin. We've been, not we, but I guess the economists, the people smarter than me, have been saying this is something that's going to disappear very quickly for over a year now, and they've been, quite spectacularly wrong. How inflation starts to become a problem is through expectations. The more people that start to go, bugger this, I'm worried about inflation, I want a pay rise, the more of us that do that, the more it becomes self-perpetuating and the more it kind of wills itself into existence. And why that second scenario is the scarier one, the one to kind of pause your breath on, is if we do start to see inflation get a little bit out of control, central banks have this mandate to keep a lid on it. They haven't had to worry about it for a very long time. If they do have to start worrying about it, it's going to mean interest rates much, much higher than what we've been talking about here. And historically speaking, that has a very nasty habit of ending in recession. And even if it doesn't end in recession, an interest rate regime where interest rates move much higher would mean a big derating for most higher risk asset classes, particularly the share market. If you remember back to my analogy of the seesaw, you push on one end, the other end goes up. We've been pushing down on interest rates for a decade now. Asset prices have had a real free kick. If that relationship starts to work the other way, then it's going to be a very unpleasant place to be an investor. I'm no better at any of you than forecasting the weather. If you put a gun to my head and asked me for probabilities, I'd say, personally, I still think the first scenario is the most likely one, but we can't discount the risk of the second one. And again, the longer the situation goes on, sadly, in Ukraine, I think the more plausible that becomes. Under either of those scenarios, we'd like to think GVF, as Emma was saying, would be a solid option for you to think about, mainly because we make most of our returns regardless of what the market does. So we make most of our money through investors by finding cheap assets, rolling our sleeves up and unlocking the value in them. And that means we're pretty immune to whatever the market does. That said, if GVF doesn't make sense for you or doesn't make sense for you, I think the thing I'd sort of try and impart, or the thing to remember, is that if we are in store for a period of lower returns, so a little less fun in the markets, or indeed in store for a bigger pullback in the market, it has to be viewed in the context of this tremendous run we've had in recent years. Share markets do not compound at 20 to 30% into perpetuity. That's just not how they work. You need to have really good, grounded, reasonable expectations of what to expect from your portfolio. And I think the biggest risk that Emma and I see when we chat to investors is that expectations have really crept higher. If you're out there today wanting another 20 to 30% from your portfolio, you're possibly taking a lot more risk than you perhaps realise you are. So that's probably the little bit of wisdom I'd pass on. And then look, we always finish these things with a couple of case studies. I find they're the best ways to try and capture what we do, explain what we do. It's a slightly different type of investing. This first one here is I think it's a wonderful example of the kind of gems that we uncover hunting around the world. One of the great investments we made during the pandemic, right at the moment of everyone else being very fearful. And it's a company called Amadeo. And Amadeo is an aircraft leasing company. So they basically own 12 aeroplanes that they lease out to airlines to use all around the world. Obviously, the airline sector was one of those sectors that got really hammered during the pandemic. And when we turned up, the share price for Amadeo had fallen 60 or 70%. A lot of fear out there. Everything to do with airlines was quite worrying. Most of the major airlines either went bankrupt or needed to be bailed out. In our view, however, this is a wonderful example of where the market can kind of throw the baby out with the bathwater. By complete luck, Amadeo had sold 2 of its aeroplanes in February 2020, so 1 month before the pandemic broke. So what that means was they came into the pandemic sitting on this massive pile of cash. When we turned up, when we started buying shares in the company, we were literally buying it below cash backing. So you think about a margin of safety or sort of deep value investing that we do, we're buying this company below the cash on its balance sheet, and we're getting the entire fleet of 12 airlines for free. That was, I guess, probably the easy and obvious part of what was exciting about it. The next part, and where we've done most of our hard work in recent months, has been understanding the dynamics of the leasing market and the companies they've leased to. Most of their planes are leased to Emirates. And Emirates has been a real kind of unique story throughout the airline industry. Whilst most other airlines have defaulted or gone into bankruptcy, Emirates has paid everyone on time and in full throughout the entire pandemic. They let go of like half of their staff, they stopped flying planes, but they kept paying everyone on time and in full. And the reason for that is Emirates is essentially owned by the government of Dubai, which is essentially owned by the Kingdom of the United Arab Emirates, one of the wealthiest families in the world. Vast amounts of oil and gas money. And they have this 20-year view on what they want Dubai to turn into, which is the next New York, travel location, art location, and an important transport hub. And they have very deep pockets. So they made a decision, and that was sort of our assessment from all the work we did, that they were going to stand behind Emirates and make sure that they were one of the good operators and that they came through the pandemic on the other side, able to take advantage of other airlines' problems. What that meant was, as well as buying the company below cash backing, we've been earning nearly a 20% dividend for the year and a half that we've owned it, and we can still see a couple of years ahead of us earning that kind of dividend stream. It's a horrendously complicated story. I'm telling you the highlights. There's other parts of this that are a bit scarier. Those are the parts that we assumed were worth zero, but that really clouded, we think, the market's judgment. And it took a little while for that reason for the market to see what we're seeing. But pleasingly, in the last 6 months, one good example of, actually I'll go on a little aside, good example of where shareholder activism isn't all going in and, dust-ups and, horrible confrontations. We built a wonderful relationship with the board. I speak with the chairman very often. And one of the journeys we took them on was the need to really return the cash on the balance sheet. They didn't need it anymore. Shareholders, with where the share price was, rightfully thought the capital should get returned. And pleasingly, they did that. So they returned all of that cash. That greatly de-risked the investment for us, lowered our entry price. And what that meant is the share price has finally found the fundamentals that we've seen is we've nearly doubled our money on the position. And as you can maybe see on the charts on the right, we can still see nearly doubling again on a very base case conservative kind of estimate. So if you're a shareholder at GVF today, you own a couple of A380s that are parked in Dubai, and you bought them very, very cheaply.
What I like about this example in particular is the news. I think so many of us have been exposed to the news, often only focusing on the bad parts of a situation and maybe exaggerating that. And what I liked about this was it's often stories like that where things have been exaggerated and everybody's just running for the hills, where somebody with a cool head like Miles, details orientated, can actually get the experts involved, can come in and dissect the company as opposed to kind of digesting what is put out.
It's airline and we don't want to be
Yeah,
involved in it.
yeah, I like
We
that.
bought a lot of this. We're now by far the largest shareholder, and it's been a terrific kind of outcome. But in the depths of it all, it was a bit scary, I will say.
Yeah.
And look, this next example is a similar sort of theme. Again, we bought this after the pandemic. It really started to establish itself. And what we're doing, every day, but certainly during periods where you get big dislocations in the market, is we're hunting around, turning over a lot of stones, trying to find some little gems. And I think this is another example of that. Student accommodation, very strange kind of thing, but it's a big industry. It's become a really huge industry in the last decade or so. In countries like Australia, the UK, the US, you have this massive export industry of education. So lots of foreign students want to come to Australia or the UK, prestigious universities, wonderful lifestyle, maybe less of a wonderful lifestyle in the UK than Australia, but you get a lot of foreign students coming in. Combine that with the fact there's obviously a lot of domestic students, and one of the interesting things about that is you get this huge demand for dorm rooms. There's a lot of students out there looking for beds. And it's been a really sort of exciting growth industry. There's vast amounts of money that have gone into building dorm rooms across Australia and also the UK. And just to sort of highlight the UK market, the thing that really drives the UK market is there's currently 3 students looking for every 1 dorm room available to rent. That's a lot of kids sleeping on couches and staying with mum and dad. One of the features that was always been really attractive about the student accommodation sector as an investor is the fact that, and if you think about this, the rent cycle is very short. When you lease out a room, it basically lasts for just under 12 months, a couple of semesters, and at the end of that 12 months, everyone moves out and you bring in the next cohort. And that underpinned, asset prices for the sector for a long time. Because there was such a mismatch between supply and demand, every year the owners of these dorm rooms could charge more and more in rent, reflecting the supply-demand mismatch. And one of the reasons why the value of these they're essentially REITs, these real estate assets, has gone up so much in recent years has been the rising rent roll. The pandemic put that to a screeching halt. So one of the challenges the sector faced was, obviously, when you hit the pandemic, everyone stopped coming to school. The foreign students stopped flying in, the domestic students started zooming in from home. And what that meant was suddenly these businesses, their costs don't change, but the revenue line just falls off a cliff. There's no certainty of rent beyond that 1 year cycle. It created a bit of a bloodbath in the industry, in the sector. We started trawling through all the different sorts of assets we could find out there. We came across Empiric, a student accommodation company that we really like in the UK. What we loved about it was we did a lot of stress testing on the balance sheet. We're very confident that this set of assets would come through the pandemic, even in the worst sort of environment. And pleasingly, 6 to 12 months on, a bit like Hamado, that's starting to be reflected in the share price and the fundamentals now. I know the news stories are all about the war at the moment, but in terms of the pandemic, in terms of the UK, student numbers are almost back to where they were, so your revenue line's back to where it was. Share price has had a big run, but is still quite cheap. And one of the things, as I was saying, we think of ourselves as asset traders, so we're not stock pickers, we're buying assets below breakup value, always with the fallback that we can sell the assets to someone else above what we bought them at. And I think this is a great example of that. One of Empiric's big competitors, GCP Living, owned a similar set of dormitories around the country, was bought out by one of the really big private equity firms a few months ago. You can hopefully see on that chart on the bottom there, Empiric is still trading at a 15% discount to book value. So if you broke the company up tomorrow, you'd make 15%. Its competitor was bought out by by Blackstone, and they paid a 10% premium to book value. So just to give you a sense of why we're comfortable owning these things, we pick up a really interesting yield from the company itself, and there's fundamentally a lot of value still within that. That's not value that we're sort of guessing are there or hoping it's there. If necessary, these assets could get sold to
physical properties.
Physical properties get sold to other players, and we pick up the uplift from that. So as well as owning a couple of planes in Dubai, you also own a couple of dorm rooms in Bristol, if you're a GDF shareholder today. G'day, hey.
Please give me 5 seconds to get to you with a mic. Hi, I'm an investor.
Oh,
For
g'day.
a long time, very happy, thank you very much.
Thank you.
Just a couple of things. It's a very small fund, 200 million.
Yeah.
Your fees are 1.5%,
Yep.
which is $3 million plus other fees. How do you do it all with this relatively small amount of money? Where are you getting the support? Who is Mirabella? What's the combined connections of all these groups that allow you guys to be out here on a pretty ordinary fee base?
Let me
sit down, please, because we can share that.
Oh, okay. We'll sit down soon. Well, I'll start off giving the really long answer to that question, and that is we're married and we're kind of doing what we want to do. Emma spent a decade working for some of the really big investment banks in London, Citigroup, Rabobank, and she spun out and set up her own little boutique. When was that? 2011. Great success. And then I was working for a hedge fund. You know, really enjoyed the work, but you feel like you're a small cog in a big machine. And we were sort of thinking about life and decided what we actually wanted to do for the next 20, 30 odd years was this. So we started Global Value Fund. When we started, it was $50 million. It was a tiny little fund. As a business, it was loss-making. Like Emma and I were not just working for free, but we were paying to turn up to work for the first couple of years.
As you do as business
real.
owners, you know.
But we've finally grown the business to the point now, and I mean, Emma has been quite successful previously, which meant there was no sort of cash flow problems for a few years. And that has meant we've kind of grown the business now to a point where it's steady state. We've got a big team in London. They're all very bright, paid very well. There's a performance fee element, which means if we perform and we have a couple of years picked up some extra fees from that, it keeps the lights on and makes it interesting for Emma and I. And we've said all along we want to get GV up to about $300 million in size. Not much bigger. If you remember, I was talking about the arbitrages we take advantage of. We don't want to get so big that we our returns start to fall. I think that's one of the big challenges that you see with investment managers, especially managers with a really niche little strategy. It's quite common kind of journey to have a really interesting track record on a small amount of assets. And with that interesting track record, you raise a lot more money and then returns start to fall, but maybe the manager retires wealthy. So we've been very keen to say from the beginning we're going to limit the size of what we do because we're fundamentally mostly only interested in the returns and what our investors get. And the other thing to say is we've been working for a while now to launch a second fund. It'll be the last fund we do, and that's an offering for some very large institutions in the world. At my previous firm, we had some real marquee the large and great institutions in the world investing in us, and we wanted to set up a smaller vehicle that could maybe cater to them. And pleasingly, Emma did a lot of the hard work. We got that off the ground last year. So a big Asian endowment gave us a $20 million investment for the new fund, and we hope to get that up to sort of $100 million over the next year or two. So the long way to answer that, it's sort of a journey. Emma and I are not terribly motivated by money. We're kind of just doing what we want to do for.
Let me add, just in terms of your question around Mirabella and resourcing, because obviously that you're absolutely right. The amount of due diligence that we do is absolutely massive. Couple of things to say. One, as Miles said, we want to maintain our small size. So even when both funds are at capacity, so when GVF is at 300 and the second fund is at its capacity, we won't run more than 400 to 500 million in AUM, which is tiny in the asset management world. What that allows us to do is it allows us to be very small and nimble. But also, we've spent the last 2 decades building a database of IP. So the world that we work in is about $500 billion in assets, and we've been monitoring that world, or we monitor that world on a constant basis and have been doing for 2 decades. So we've built up a lot of IP in the space. The other thing to say is we have very senior portfolio managers. So we have Miles. We have James Dow, who's worked with us for 2 decades. He's the trader, very introverted. You probably won't see him much front-facing, but he's very experienced. And we hired 2 years ago a very senior chap who'd been on the sell side of this business for 10 years. And you're absolutely right. People of that caliber managing the amount of money that we're managing is unusual, but I guess the way we looked at it was we'd rather resource the business before we get to the size that we want to get to. And I think that's been really motivating for us. In terms of Mirabella, you asked about Mirabella. You guys will know, especially in the UK, Australia, and the US, regulatory requirements and compliance has gone ballistic. So instead of tying ourselves up with regulation and compliance, what we do is we use a company that's sole focus is to do compliance and regulation. Mirabella actually does the compliance and regulation for 26 billion of assets, of which we are, 230 million. But we just felt that having a firm like that overseeing us, making sure that we're doing all the right things, was a much more efficient way than Miles and I suddenly becoming compliance and regulatory
experts on the weekends.
Experts. Does that answer your question? Please.
I guess I'm happy with everything, but I'm concerned about the key man aspect of
Yeah.
you two guys, and the fact that I don't know whether the total fees you got was obviously much more than 3 million. One of your staff probably gets $3 million in London, so I don't know how you do it, but I'm more concerned if you get run over by a bus, the two of you.
So I guess as a business, everyone apart from Emma and I are paid market rates very well, and they're incentivised to make it a big success. And Emma and I are taking a 10, 20 year view on doing this. We're doing what we want to do. We're not really motivated by money, especially in the near term.
Yeah.
In terms of the key man risk, we get that question a lot, especially on this trip. I guess the Hamish Douglas affair has put it on everyone's minds.
Yes.
What I like to say is I sort of find it flattering. Emma and I think, get too much of the credit because we're the ones that come out and meet everyone. In terms of the investment team, there's myself, there's Mark Ambrose, and there's James Dow, all in their 40s, all have been doing this for 20 years. And we all collectively make every investment decision. So it's not like there's sort of a me dictating down. It's a very collaborative environment. Mark especially is very senior hire for us, and what we were saying was we'd probably bring him out in the next few years so he can meet more of the investors. So if I would be hit by a bus, the proverbial bus, you've lost a third of the investment team, not 100% of the investment team. And just to say, a lot of what we do is on the trading side of the business. It's been running it for 15 years. It's almost mechanical. James has been doing that stuff forever. So obviously, with any kind of active investment management, there is the risks of the key people in the business. But to sort of ameliorate that a little bit, we get far too much credit. There is a much bigger team behind us. It's just we're the ones that put on the tie and come out and say hi to everyone.
Don't fly on the same aeroplane.
Yes, exactly.
My sister said the same thing because she would inherit our kids.
Yes, exactly.
But it is a really good point. And the thing is, you do take a risk. That's the reality. If you're going to work with a smaller manager, it is something that is worth considering. That said, smaller managers that are more boutique like ourselves also tend to produce better returns on a risk basis.
G'day.
Could you tell me how many staff do you have? And do you live in Australia, but you've got this big office in London, and I want you to fly over there, or you have Zoom meetings, whatever.
Yep.
And then you fly around the world a bit looking for growth potentials, as you say. Is that how it works?
I'll articulate it a bit better. So no, I grew up in Sydney, but I moved to London in 2005. So I've been living in London for 20 years. And the team and I and Emma are based in London. So we're a London business. But we've obviously got the Global Value Funds, an Australian investor base. So we come out here a lot to meet everyone. And as an Australian and hopefully a soon-to-be Australian, our plan was always to move back. We've been investing a lot in the team. So on the investment side, there's myself, Mark Ambrose and James Dow. So 3 guys all in their 40s. As Emma was saying before, if you looked at like a big fund management business, we're in the business of fund management as opposed to sort of a boutique. 3 senior guys like that would be probably managing $2 or $3 billion. We're managing a couple of hundred. And we've recently just made another hire, a young bright spark, an Oxford mathematics grad, can speak 3 or 4 languages, can program in 3 or 4 languages. So he's come in to sort of be our new grunt. And that has sort of gotten us to get London where we wanted to. And the bits of news we've been saying to our investors, I should have mentioned earlier in the speech, was that we will be opening an Australian office later this year for 2 reasons. One, from a business point of view, we invest a lot of money in Asia, and it's hard to do from the London time zone. So we've worked out the numbers. We've invested about 1/3 of our capital in Asia since starting the fund in 2014. And that 1/3 of the capital has generated a good bit more than 1/3 of the profits. So Asia has always been a really interesting place to invest. It's just been a very difficult thing to service from London. So we're going to open an office in Australia, maybe hire 1 junior in the near term, and have a big push on trying to do the Asian markets a bit better. Mark, James, and our new hire, Marius, will still stay in London. And then the second reason is a personal reason. It's like Emma and I always wanted to end up in Australia. I've got parents in Sydney, grandparents for our kids. So we've been sort of building the business to the point where we could open that second office and move out.
The only thing I'd add to that, it's completely gone.
That's good. But and we, to say we will still spend a lot, to your earlier point, we'll still spend a lot of our life on the plane back and forward between London and the Zoom meetings and trying to make it all work. Yeah.
Oh,
Thanks very much for that presentation. I found it very interesting.
thank you.
A couple of quick questions, a really main one. What are your fees?
Yeah. Our fees are 1.5% per annum, and we charge a 15% performance fee over a hurdle and a high water mark. The hurdle is cash rates plus 4%, and the high water mark resets every year.
Thanks.
Just one more thing, I suddenly realised what I was going to say. The other reason for the move back to Australia, and I want to talk a little bit about our share price just for a second. In general, GVF has traded at NTA. If you look at our share price from 2014 through to the end of February this year, the average discount premium that we've traded at is a 2% discount. So very close to NTA, especially in the environment of LICs where a lot have traded at a discount. That said, over the last 6 months, 12 months, we have traded at a maybe 3-4% discount, which is quite unusual for us. And we feel that if we were to take a leaf out of Jeff Wilson's book in terms of managing LICs, his holy trinity is performance, yield, marketing. And given that we've delivered on performance, and I believe we've delivered on yield at 9 cents grossed up every year, the marketing aspect and the fact that we've been hamstrung, we've been stuck in London for 2.5 years, haven't been able to see our investors, that has built in a small 3-4% discount. And I think moving back to Australia will give us the opportunity to spend a bit more time with our investors, something that we're motivated to see us go to that NTA/premium.
Yeah.
Thanks, Al. Good morning all, my name's Edward Patching, and if your chair would allow, and if Miles would allow, I'd like to offer a confession and a comment and a warning.
Okay.
My confession firstly is that I'm one of those terrible Mexicans who fled south from Canberra over a year ago and find myself newly established in the Gold Coast and think it's a wonderful part of the world. So thanks for welcoming me here, and bad luck for all you guys paying full rates, because I think Rod Glover's offer was excellent and I'm signing up as soon as we're finished here. My comment is an extension of what Emma just said in referring to Jeff Wilson. Many of you here will be aware of the name Jeff Wilson. His funds are one of the prominent ones that are around, and that reminded me that during my time in Canberra for 5 years or so, I was the ACT chairperson for the Australian Shareholders Association, another body that some of you here I hope will be familiar with, largely volunteer, group that works to promote the interests of retail shareholders. So in my role as the ACT chair, I would occasionally find myself talking to fund managers, many of whom were a bit inclined to be dismissive of retail shareholders. 2 stood out who weren't. One of those was Jeff Wilson, and the second one is the gentleman that we see sitting over here. So my estimation of Global Value Fund and the people associated with it went up when I found that I was dealing with a person who was genuinely interested in the shareholder perspective. And over the years I've watched GVF go along, and I've been quietly impressed. Well before we all started thinking about ESG, environmental, social governance issues with some of our investments, Miles was actually doing it. So that, for instance, he also does a good job of keeping shareholders informed with things like a monthly newsletter. I looked at the most recent one for February yesterday, coincidentally. He has a bit of a general blurb about where he sees the world, where things are going, and often gives a bit of mini case study type stuff. He referenced 5 companies in which GBS has an interest, and on 2 of the 5 companies, this gentleman and his team had been active just in the last month, 1 in getting a director on the board, and 2, secondly, in arranging some return to shareholder of funds owned by that company. And I would just invite you to reflect, those of you who hold managed funds or are involved with super funds, how many of those funds can say that in the last month we were involved in kicking boards up the backside or encouraging them towards better returns for our shareholders? So I would simply applaud that approach. Miles mentioned it's part of what they do to unlock value. I've watched them for a while and I think it works. So well done, that's that. The last part is a warning, Miles.
Okay.
My warning would be, if you do get going with a second fund, and I can understand why initially it might be attractive to the big institutional retailers, but if you don't find a way to open it to this retailer side of the market who might be interested, then we, the retail shareholders, will be hounding you and will be very unhappy with you. Yeah.
That's tremendously kind, Edward. I'm a bit embarrassed, but thank you for saying all that. I mean, I'll let Emma say a few words too, but I mean, on the second fund, we get so much joy out of running a retail product. We get to meet so much of the interesting people around the country. We get to see so much of the interesting country. One of the big challenges I had with convincing Emma to come back to Australia was she saw so much of Australia. The first thing she said was, I'll move anywhere in Australia with you as long as it's not Sydney or Melbourne. So that was sort of her opening gambit.
I still feel that way.
But having that second fund, so just to say on the second fund, it's essentially the same product, exactly the same fees. They're not getting a fee haircut or anything like that. But having relationships with those big institutions does have some benefits that benefit everybody. And do you want to run through the AA4 example of those?
Yeah. I mean, well, the first thing to say, just the reason we launched the second fund was because we wanted to diversify our business. So we knew that we had our GVF investors, 3,500 retail shareholders, and in order to be smart business owners, we thought if we launched the same fund but to a completely different audience, that would be a good way to kind of hedge ourselves, I guess. So the second fund is a US dollar denominated version of GVF. It's in the Cayman Islands. It has a $2 million US dollar minimum, and it's predominantly for large US endowment funds, so the university endowment funds, who love what we do. They see that we won't scale it, and that's the interest there. But as Miles said, as well as a business diversifier, it actually can work very much in the hands, in favor of GVF. And I'll give you an example. Amadeo, the case study that Miles ran through, a very big block of stock came up in Amadeo. One of the fund managers who held the stock had been told from on up high that he needed to get rid of anything to do with airlines because of ESG. We can debate what that means, but ultimately he was told sell everything to do with ESG. Really easy to sell American Airlines if you own that. Not so easy to sell something like Amadeo. And what happened was it was a large block of stock, and we had more than enough. The block was way bigger than what GVF needed, way bigger than what our second fund, SVF, needed. And the first investor into SVF turned around and said, listen, take the whole block out and we'll fund the rest of it. And this is often the case with these large institutions. They can make, $5-10 million available at 2 to 3 days' notice. What happened was we were able to negotiate that block at a price that we would never have got for GVF, 15% below the market. And I think having that access and firepower is something that we think is really positive for GVF.
Just to add, so, I mean, one of the advantages of those big institutions, they're not quite as friendly a bunch to talk to, but they have access to a lot of money, and there's certainly times in the market like this trade that came along. It's like we went to them and said, we think this is an amazing opportunity. We think if we had some more firepower, we could really negotiate a great price. And we ultimately managed to get a price that was 15% below the market just because we could buy the whole block. And then everyone benefits. So GVF gets set 15% below the market, and they obviously get the rump of the trade at a great price as well. G'day at the back.
A wonderful presentation, Emma and Miles. You made reference to hopefully the positive scenario that might come about rather than the negative one where we just have galloping inflation. Miles, I'm going to Sydney next week and I'm a Sydney boy. I've got a solution for you too.
Okay.
I live in northern New South Wales.
Okay.
You could set up probably on the Gold Coast and live still in New South Wales, Miles.
Exactly.
You could live at Benora Point or
I love this
somewhere
man.
else like that.
You're not making my
I
domestic
live
life
in
easier.
the last house in New South Wales, literally the last house in New South Wales. The stage is the Queensland border, actually too close to them. So there's your solution, and then you can take part in our wonderful community here on the Gold Coast. And somebody was talking about, not paying for stuff. A couple of friends of mine and I, we cycle the Gold Coast cycleways and we enjoy the Gold Coast lifestyle. But we don't even pay any rates around here, so we've got it nailed.
The value trade.
Brilliant, the value
We
chain.
would, I mean, in truth, I would move here in a flash. I mean, the handbrake has been my mum and dad and the grandparents. I've been away for a long time. I've got 2 young kids. And it's just, it's
we
tough.
love
We
them.
look very closely at places like this. Also, Toowoomba, Emma kind of had her heart set on. Emma grew up riding horses in the African, she's South African, grew up riding horses in the African bush. So I'll move here in a flash. If you can convince my mum and dad to...
It's going to be difficult to organise the riding horses in the African bush, but everything else, we can nail that.
And,
thank you very much for today.
Cheers,
Thank you so much for the feedback.
Just a couple of others. One of our sponsors for this group is the Collins Street Asset Management Fund, which is a private fund. Do you know them?
I don't know, no.
Okay. They say that they're the number one fund return. They've been judged by Morningstar.
Yep.
They are, you've got to be a sophisticated investor
Okay.
to put money in with them. The minimum, for us, they say it's 100,000, where other people it's 250,000, and you've got to have net assets at, I think it's 2.5 million.
Yep.
Are you for sophisticated investors only?
No,
What do you want to...
we're available.
If not, what is the minimum amount?
$1.20. Our share price is $1.20, and we're on the ASX. So no, we are fully retail.
So this is quite a sophisticated strategy. One of the great things about LICs in the Australian market is you can wrap up a reasonably sophisticated strategy and make it available to, retail investors. So there's no minimum. We just the ASX code is GVF. You can buy and sell shares on the ASX, and the minimum is just the minimum. One share, so $1.20.
How do you intend to increase the share amount?
Hang on, I'm coming.
So
How do you intend to increase the amount of shares in the future, what you were talking about earlier?
yeah, so we started off very small, $50 million. We've grown to 210 today, and we've said we'd like to get up towards 300. If we never do, we never do. We've done that because we've always traded really well. So we've historically spent a lot of our life trading at a premium to asset backing, and that's meant that we've managed to do some follow-on capital raisings over the years. I think we've raised a little bit of money sort of 6 out of the 7 years we've been going, 6 out of the 8 years we've been going. We normally do that kind of through word of mouth. We'll do a small issue, $20 or $30 million. We always prioritise our existing shareholders first, but there's always been a bit left over as well. And that's kind of the way we want to do it. We don't want to suddenly double in size, just growing slow and steady through time is sort of suits us best.
I remember earlier in the piece you had a share buyback.
Yes, yeah. No, we have a really unique dividend reinvestment plan. So
We haven't bought back shares though.
we have through the DRP. So when we set up the LIC, one of the things that I noticed with LICs in Australia was that the managers ran these dividend reinvestment plans no matter what. And I always thought that wasn't so great, because if your share price is trading below your asset backing and you issue new shares to investors, you're sort of taking value from one shareholder and giving it to another. And arguably, it's kind of in your own best interest. Every manager wants their fund to be bigger. So what we did, which was a bit innovative, and it took us six months with the lawyers to figure it out, was we have a DRP, or dividend reinvestment plan, whereby if our share price is at a premium, we'll issue new shares to people that want to take up the dividend option, the reinvestment option. But if we're at a bit of a discount, and that happens from time to time, then we don't issue new shares. We go into the market and buy new shares on behalf of the participants. So and that means we're obviously not growing our AUM, which is not so good, from a business point of view. But I think on a principle, is a much better way to run that kind of operation. So the only times we've ever bought back shares is through the DRP. And it's going to be quite neat. When we set that program up, I think half a dozen other LICs have kind of copied us over time, so it's nice.
Which is good. Yeah.
Nice too.
Good for the market.
It's a bit over, so markets are moving around, but say about $1.22, and yesterday the share price was $1.19. That's all right. The question was, what is our NAV at the moment? The pre-tax is about $1.22, and the share price is about $1.19. Well, one thing to say too, just to put it in maybe easier language, Emma said we've always paid out like an 8 to 9 cent dividend. To turn that into more useful language, we've always had about an 8% fully franked yield. So we're paying out quite a lot of income, 8%.
What percentage of the what percentage of your profit is that generally paying out?
Well, so we aim to pay. So we pay. The premise from the beginning was to pay everything out. And we kind of want to give you the choice of whether you reinvest it as opposed to forcing you to reinvest it. So we pay out this 8-9% dividend, and if you want to reinvest, you're obviously welcome to.
Thank you.
So, hey, look, guys, I think we've kind of worn you all out. So thank you very, very much, and we'll be hanging around if you want to ask any more questions. Thanks for making some time.